So look at what you wrote and let's see how close you came. Anybody want to give me this formula for duration of net worth? Duration of assets.
Yeah. Divided by the assets. And then multiply by the it's another parentheses that multiply by leverage.
What is leverage?
It's
Bottom of assets, so we're talking about work. All right, it's not a real complicated, difficult formula. So the way I think of it, it's duration assets minus duration liabilities. But we got a problem. We have more assets than liabilities, so we got to weight the. Oh, sorry. You're probably wondering what's an S. So I'm trying to type. So essentially, duration of assets minus duration liabilities. But we're going to weight the liabilities down because their weight isn't as powerful because we have fewer assets than we have liabilities. But then we have to leverage it up, which is just assets over net worth. The word leverage a lot of times does mean assets divided by net worth. If you did the ROE decomposition, that was a definition of financial leverage, assets over net worth. So, tied to another class, think about it in the context you've had it before. All right. Here you'd have to get the duration of assets. What might that be here?
It's
Duration assets is going to equal what? Give me the actual numbers. So say again, 200 divided by 2,000. I mean, you can do that if you want. What would that be times? Times 0. So you can't ignore that piece if you want to, because you're just going to get 0 there. Then what? Say it out loud. Times 5. All right. So that's going to be your duration assets. You'll put that into the formula and you'll calculate it out. Where it could go wrong on your formula, that's where all these parentheses make sense. I don't count out for math errors unless you should know. So there's sometimes where, just look at it. That's why I can tell, I think exam anxiety, some students just like, they write everything down and don't stop and think what they just wrote. I mean, it still amazes me students that turned in papers in my last semester where they calculated a value of a stock and got a negative number and submitted that without it bothering me. And it should have bothered them. I'm not saying they're not smart people, but it's just sometimes we get so into the weeds. So step back and kind of think about it. This firm, the duration of assets is going to be greater than 3.2, isn't it? And if the asset duration is greater than liability, you're going to have a very positive net. The only way duration net worth can be negative is for this number to be substantially larger, because it's already starting off with a disadvantage because liabilities are already smaller. So this is going to be a positive duration of net worth. So if you get a negative number, your mind should kind of say, okay, wait, this number is substantially larger than that one, and it's the bulk. It's 90%. So it looks like what, about 0.4, 4.5 or something. That's going to be a much higher duration. So, all right. Any questions on that first one? Now, tomorrow morning, if you got up and wrote this formula, which I'd highly recommend you do, first thing tomorrow morning, I'm going to write that duration formula first thing in the morning. That would be spacing and quizzing. You'll see the technique, and there's studies that show it's not 5% better, 10% better. It's like 0% versus 70% remember. I mean, it's an amazing trick for the mind. So stop cramming. My classes are terrible for procrastinators. It's just horrible because your mind can't learn that way. So just quiz. So yeah, I tried this book and I tried it with learning all the countries. I might have told you all this, but I want to learn all 196 countries in the world. And I've been trying my old way and I couldn't do it. And then I tried spacing and quizzing, and in 2 weeks, I know where all 196 countries are. And it's been amazing because The Economist mentions 40 to 50 countries a week. And now it is not only can I picture where that country is and what countries surround it, but then I remember that story 2 weeks later. It's an amazing, I would recommend you all learn. If you want those quizzes, they're online, they're amazing. I thought it'd take me forever, especially like Asia. I mean, it's like, where's Laos? Where's Cambodia? But now it's like, I know it exactly. Where's Ivory Coast? Ivory Coast is right next to Ghana, right next to Liberia, right next to Sierra Leone. Yeah. I mean, it's your mind can see it, and then you hear the story, and so now I know, wow, just what's going on in this country. Wow, it must be because it's right next to Burkina Faso. Man, that country's going through. So you know, it's your mind remembers. But it took me 2 weeks to learn. Can you believe that? After 2 years trying to learn them, oh man, I can't remember what that is. And you know, so it's that spacing and quizzing. So tomorrow morning, say, hey, tomorrow morning I'm going to write this formula down first thing. And if you can't remember it and you mess it up, that's actually good for your brain. You write it down and you check, oh, I forgot to do the leverage at the end. All right. Okay, what's the formula here? This is a formula everybody should know. It's one of the most famous formulas in finance.
Duration.
Yeah, and Bill Gates always does that. Minus duration, what'd you say? Now, what's the change in yields in this case? How would you write it?
Plus or minus.
Yeah. So they're rising. So let's write it out this time. I'll write duration net worth for that, but we have minus duration of net worth times what?
Plus 0.050.
0.15. So you got minus duration. The duration here is obviously going to be plus minus the duration times that. So you're going to get a negative number, right? Because we know the duration net worth here is going to be positive. All right. How do we get from 150 to 0.015? Divide by 10,000. Yeah, if you're not used to basis points, get really used to it. Kevin's going to be hearing basis points in his intern. Trade desk. They don't even give the risk-free rate. That was an amazing thing to do. They don't say treasuries plus. They say 15. They don't say basis points. I mean, they're really lazy people. 15, 18, 27. And it's not like, you know, it's just numbers. So basis points is pretty important. I mean, if you're interviewing, you want to say bips because it sounds cool. But in reality, we don't even have time to say basis points. We're so busy. All right, everybody's comfortable with that? Very famous formula in finance. So Thursday we'll do the actual math. But I would say tomorrow morning, get up and write those two formulas without looking at your notes. Thursday morning, get up and write those two formulas without looking at your notes. And then 3 weeks from now, you'll still remember those without looking them up. That's how the brain works. It's spacing and quizzing. It's an amazing thing. All right. You can't answer this one yet. But what about D? Plus or minus 4 years. All right. I don't know how else to explain that one other than just I usually just look at the 100. We know it's minus duration times the change in yield. So if the change in yield is 100 basis points and they allow 4%, then that's got to be 4 years. It just fits into the formula. It's pretty straightforward. Don't forget the plus or minus, though. It is plus or minus. You can tell that from this table. All right. What's the first thing you do in question 2? Do the difference. And sorry, this was exam for 2 years ago, so it's still LIBOR, but what's the difference here? 170 in here. Is that the normal or is this the bizarre question? Is that what you expect or is it out of whack? That one you expect. Why? Term structure of credit spreads. Longer term bonds, high quality gets a bigger difference than floating rate. Okay, write that difference down first. I'll probably have SOFR on the exam, but that shouldn't bother you. Bill Gates is so picky on stuff like this. All right, so who has the advantage on fixed rates? So AAA has the advantage wherever the number is bigger, which means AAA is most likely going to have the advantage on fixed rate all the time. They're more highly rated, but you know, I may throw a curveball, who knows? So AAA. All right, I haven't done the swap yet, but what were y'all getting on the swap? So AAA is gonna borrow what first to start with? Yeah, wherever they have the advantage. So they have advantage on fixed. So they're gonna borrow on fixed. Wherever the 170 is, that's what AAA is gonna be. Wherever the lower number is, that's where triple B is gonna be. Everybody understand that? There's no swap there. They're just borrowing money. All right, nothing wild's happened yet, but we got to set up the swap. So they borrow, and remember, I do plus T plus 10, and I do plus L plus 35. So make it really clear. If they're paying, it's a plus. If they're receiving, it's a minus. All right. And then we do the swap. AAA receives treasuries. That's a minus T. And receives 75. Which means triple B must be doing what? Paying T and paying 75. If I were you, I'd do them at the same time. Oh, if AAA is receiving that, then triple B must be paying that. And then triple B receives LIBOR, so they must pay LIBOR. And they receive LIBOR. So a plus sign means they're paying. A negative sign means they're receiving. Why? Because I'm looking for the cost of debt. That's why I'm saying a positive side is them paying. So what does AAA have? T minus T plus L. 10 minus 75 minus 65. Did y'all do the check to begin with? What's the difference here? Yeah, 170 minus 30 is 140. What's half of 140? What's 10 minus 70? Or wait. I'm sorry, what's 5 minus 70? Excuse me. 5 minus 70 is minus 65. So the difference here, 140, we're going to essentially split it 50-50 between the two of those. Since they're going to end up in LIBOR, they're going to get LIBOR minus 65 instead of LIBOR plus 5. And then triple B, the LIBORs go away. So T plus 110. So you take 170 minus 30, that's 140. Take 140. Subtract, divided by 2, that's 70. So 180 minus 70 gives you 110. Now, as I said, I don't think that's how it really works in practice because you have no earthly idea triple B exists if you're triple A. You only know about the investment bank. And so, but I know it's how it's taught in other classes. I do it like this because it makes it easy for me to set the problem up, but don't automatically assume that.
If I put it as S on the test, it'll still be blank.
Do it as what?
If I do S instead of.
Well, I'll probably do so for on the exam if I remember. Yeah. Yeah, we should update. But I retired before SOFR came around, so that's my excuse. All right, so that one you could actually do the math without a calculator. You don't really need, if you're pulling out a calculator for this one, you're probably doing something wrong. It shouldn't be really, really complicated math. All right, well, I'll highlight all of this, but the answer is this very last one.
Would that math be sufficient, or do you want us to explain it out in words what we're doing?
No, you just have to do this. I would write it exactly like this. You don't have to do the arrows and all that kind of stuff. That's all I need. So you don't know on this one, but which of these entities is increasing the duration of their liabilities? B. Why? Because they started floating and they ended fixed. So the duration of liabilities, because we're focused on the liability side, the duration of liabilities should go up. That's probably going to be the right answer because we know in question 1 it was a positive duration. And then AAA started fixed but ended up floating. So they're reducing the duration of liabilities. So when would you pick triple B? If the duration of net worth in question 1 was a positive number, you'd be picking triple B. If it's a negative number, you'd be picking triple A. All right. But we don't know that yet. All right, dollar duration gap, we won't calculate it, but what's the formula here?
Duration assets times dollar value of assets minus duration liability times dollar value.
And then you take all of that. Not the notional. Well, how much notional I mean, that's what we're after here,
Oh,
right?
yeah, you divide the notional by, what you call it, the duration.
By 4, yeah. So this inside here is the dollar duration gap. That's the dollar duration gap, that formula. And when you divide by 4, it tells you what notional you need. All right. So be real clear what we're asking here. So the dollar duration gap analysis is that first formula. You use that to try to figure out how much notional you need. The amount you need depends on what duration you're getting on the swap. So once you get the dollar duration, so essentially what we're going to say is take dollar duration gap divided by the duration of the swap equals the notional amount needed in the swap. All right. To make it really clear what we're doing, that first part of the formula is the duration gap. You divide by 4 because that's the duration your swap dealer is offering you. And that division gives you how much notional you need to tell them. And remember, you can ignore the plus and minus sign. Okay, if you get a negative number, just so if you want to say the absolute value of that, it's really what we're after. A negative, positive, I mean, it does tell you, do you want to be on the floating or fixed side and all that, but you've already determined that in the previous question. So here you just need the notion. You've already told them you want floating for fixed or fixed for floating. Now we just need the notional. So I would never tell my swap dealer, oh yeah, I need negative 175. That would not mean anything to them. I've already told them I want to go from floating to fixed and I need 175. I want to go from fixed to floating, I need 175 or whatever the number is here. Questions on that one? All right, so what would be in this answer? I get some pretty skimpy answers on this. I don't know if it's exam burnout or what, but what would be some of the components of this answer?
It's not arbitrage because it's special power, but it's all.
All right. Because I like to say replace interest rate risk with and I agree with it is a special type. So yeah, it is a special type of credit risk known as what? Yeah, counterparty. Counterparty risk probably applies to other things as well, but counterparty risk. What's unique about counterparty risk versus other credit risk? Yeah, either side can owe the other at different times. However, both have exposure to the other, no matter who owes. That's what counterparty risk is all about. Oh, I owe you money right now because interest rates are in my favor. However, it's possible rates could change. You could suddenly owe me. So I still have exposure to you. Even though I owe you money right now, I still have exposure because it could change overnight. So I still have exposure. If you want to get really sophisticated, how do we calculate that exposure? What's it called? Anybody remember that? Takers on that one. It's known as potential exposure and is essentially what kind of calculation?
Value.
Yeah, it's a value risk calculation. That would be a full answer. I can't really think what else you could put into it, but that's the full answer. So normal credit risk, someone borrows money from you, you're worried about them not paying you back. That's just normal credit risk. This is different because you don't know who owes who, but it doesn't matter. You still have an exposure because things could change very quickly. And how do you expect, and this is how we calculate USA potential exposure. I essentially ran a value risk and say, okay, given this probability, how much could they owe me? Right now, I owe them 200 million bucks. So, you know, there's a 1% chance they could owe me 50 million. Or right now they owe me 200 million bucks, but they could owe me as much as 500 million bucks. It's a value risk kind of 1% of the time. I think they could owe me this much. So that's what my exposure is. Okay, questions on that? You got to put it into your own words, but these are the type of things. A lot of students just stop with that, which, you know, that's kind of there, but I want to see the words counterparty risk, but also see what is counterparty risk. Don't just say, well, it's counterparty risk. So they reduced or eliminated whatever their interest rate risk, but they did it by picking up a credit risk they didn't have before. So they're substituting one risk for the other. The interest rate risk was the bigger risk, so it's probably a good transaction still, because remember, the swap does have a lot of collateral behind it. And if rates do change, new collateral has to come in. So we're talking about rates changing fast before they can get the collateral in, but that happened in 2008. That weekend Lehman Brothers went under. Rates changed a bunch, and it was a pretty dangerous weekend. So it can be pretty disastrous. All right, everybody's good on that. So on Thursday, we'll work these other ones and get the math done. We'll use calculators, but I just want to get the problem set up. All right. What's the formula here?
Number of standard deviation. Standard deviation.
Okay, let's actually write it out here. So what's the mean here?
0.06. 2.43.
Is that what y'all got? 2.43, does that sound right? So what is our risk tolerance? So the table value, what table value are you gonna look for? 1 minus 0.0075, that equals 0.9925, is that right? So you go find 0.9925. There it is right there. 2.43. That looks right. Times, and what was their standard deviation? 10. All right. And it is the absolute value of that. We don't write it as a negative number because we just know bar is a loss. If you want people looking at you funny in an interview, which you probably don't, you don't say, yeah, my bar is negative 15 million bucks. That just sounds really weird. My bar is 15 million. Oh, you would lose 15 million. They're not going to say, oh, is that a gain or loss? It doesn't make sense. I don't know anyone that their 1% worst case scenarios, they make 15 million bucks. That's just not very normal. So we just assume it's a loss. At USA, it was like $4 billion. It's a big number. All right. So we'll calculate that on Thursday, but everybody remember that formula. It's not a difficult formula. You should have used it a lot in previous classes. So hopefully you're remembering it. That's another formula I would write down tomorrow morning. It's a pretty famous formula. And then we get here, it's the same thing again, isn't it? What did I do differently? Well, one I did in percents and one I did in dollars. So I'm just making sure you can do it as percent. The first one is just looking at it in percents. This one, we're looking at it in dollars. So what's the table value here? So what was the tolerance? 1 point. Well, what's the table value you're looking for though? 0.9875 maybe. So find 98.75 right there. 224, is that what you said? 224. You notice how I like to use numbers that are actually in the table. Well, not to give you any stress about interpolating. As I said, I had one professor have us interpolate. That's just crazy. And then the formula is the same. It's the absolute value of the mean. You're not any new formula times number of standard deviations times the standard. But in this case, we need it in dollars. So you're going to have to multiply it by the notional amount. So if I ask for the dollars, you'll have to take that percent you get and have to multiply by the notional and get it into dollars. So in this case, it's going to be the mean is what?
0.
0. So it's whenever it's a daily bar, the mean's always going to be 0. And then the number of standard deviations 2.24. What was the standard deviation? 1.6. And the notional here is 100. We'll see if they're in compliance or not. You can compare it to the budget and see if they're in compliance or not. Are struggling with any of those? And the next question, the same formula again. Right? I'm not giving you anything new here. So what's the table value here? 1 minus 0.015, is that right? 0.985. 985, is that in the table? 2.17. And same formula again, the absolute value of the mean minus number of standard deviations times the standard deviation. Are we doing it in dollars, or their budget's 1.4 billion, so we're going to multiply it by the portfolio value. So in this case, it's going to be the absolute value. The mean is 0.06 minus 2.17 times the standard deviation is 10 times the portfolio is 10 billion. You might do it in millions. And you'll compare that to the budget. The budget was in dollars. So if it's in dollars, you're going to have to multiply that by the dollars. So really easy. The three questions, the same questions. You just got to know whether you're in dollars or percents, but it's the same formula 3 times. So that one should be really straightforward. And then this last one, I don't know what I'll give you on this last one. I change it every time. The others are going to be real similar to that, but the key here is someone says, hey, what's our probability of hitting X? Essentially, whatever they tell you becomes your VAR. Okay. So what's the chance I lose 14%? Well, that's going to be, so think about the normal distribution. So you have your mean and you're looking for 14%. So you're trying to figure out how many standard deviations is negative 14. So you have to put that negative number in there. That's important. How far is negative 14% from the mean? So what is the mean here? It's 0.06 minus the number of standard deviations times 0.1. All right. And that's, what are you searching for here? We're asking for our probability. If you're asking for our probability, what are you looking for? You're looking for the number of standard deviations. That's what you're, so if someone asks, what's the probability? Then they're going to give you a number to put on the left side. And the thing you're solving for now is the number of standard deviations. Okay. You'll have to calculate that on Thursday, but y'all see what I'm talking about. So we could have asked, what's the probability of them making 30%? What would you have done then? Positive 0.3 equals that formula. All right. We can find those probabilities. What's the probability of them making 6% or more? 0.106. What's your answer going to be? 0. Right? Because you're right at the, you're 0 standard deviations from the mean. All right. So this you should have had in stats, but the problem is your stats professor might have done it all differently. Isn't that frustrating? You have the exact same material in 4 classes and you have no clue that it's the same material because we all use different jargon. It's one thing that really bothers me. I teach a EMBA and I know I teach the exact same stuff as the accounting class. And it's like, wait, we've never seen this before. Yeah, you had it last semester. No, we've never had it before. Of course, with EMBA, if you ask them if they've ever had anything before, guess what their answer is 100% of the time? It's always no, because they're scared. You're going to assume they know it. So we're going to be doing some basic addition. Oh, we've never had that before. You remember how to do that? So, no, you've had that before. All right. So that one, you just have to do some good old algebra and figure that out. All right. So keep this with you and bring it Thursday. So you don't have to redo the whole thing, but we're going to do the calculations so that we get what? Spacing, right? We're going to do it again, but do it slightly differently. All right. I will put the final one of this out there so you have a good practice exam. But all right, let's talk about the essay question because y'all were asking about that. So I will put an assignment on Canvas its due date will be Tuesday at 7:30. So I won't actually put the grade for that on Canvas. That the exam will have the grade, but I'll be there to collect it. So just to warn you, because of the way Canvas works, once I grade your essay, I like to say I'm done with that one so I can get rid of it. So I just type the word receive. That works great, except one student says, oh, I sent the wrong draft, so that sent a second one. If you send the second one, I can't type the word receive, so I have to give you a 0. Don't panic. I'm just getting it off the queue so I can go to something else. So your grades won't be in there, but it'll be due on Canvas. So you can write well, hopefully you've already written the essay, but you can write the essay before Tuesday, but it's due Tuesday at 7:30. All right. There's 2 things involved: Robert Arnott's article and my blog, and your class notes as well, really. So let's see. Talking about spacing and quizzing, the 4 risks that Arnott talks about, he doesn't really, but
Career risk, peer risk, asset, risk, like the risk of it, your assets going down, and then asset liability.
ALM risk. What's the biggest of those 3 risks?
ALM.
ALM risk. All right. Of ALM risk, what are the 4 risks there? Arnott only talks about one of them. What does he talk about?
Interest rate, inflation, and
I didn't hear the first one, but longevity. Yeah. Interest rate, which is the only one Arnott talks about.
inflation.
He does talk inflation a little bit, but
Anti-selection.
anti-selection, right? He doesn't talk anti-selection at all. All right. So you talk each one of those. So the largest one's ALM. He gives you some numbers in the article you should put in there, even though they're dated. All right. But why do people focus in on?
Career risk.
Peer risk, not career, but they focus on peer risk because it influences career risk. All right. And then these 2 right here, if you know how to discount $500 for 3 years and 30 years, you can use my exact formula to do that. Because what does it show you? The 3-year cash flow is a much bigger part of the liability than the 30-year. But the 30-year comes from, the volatility comes from the 30-year. So you can show that by what? Doing the $500 at 5% and doing it at 7%, doing it at 3%. You can do that and show that. That to me would be the easiest way to do it. You can talk it in words, but me, it's easier than math. And the same thing with the symmetry. You can actually go have interest rates fall 100 basis points, go up 100 basis points, and you show that the liability rises a lot more when rates fall than it falls when rates rise. Or you can quote him. He has the numbers in the article. You can quote him as well. So he has that in there. A lot of students miss the symmetry entirely. In fact, a lot of times they're like, where's the symmetry? So I search on the word symmetry, which I have to do it twice because I don't remember the 2 M's. I don't know how to spell it. I don't even know. That doesn't even look right to me. So I had to search your document, every spelling of symmetry I can think of, and some students don't have it at all. What does Arnott recommend? He has 2 recommendations. The first one doesn't make sense to me. He says balance the 3 risks. Why would you balance the 3 risks? Because one of them is a lot larger than the other 3, but the other 2. But he says balance.
The other one says get at least 2 out of 3.
Or get 2 out of 3. So that doesn't make sense to me either. Especially if you get peer risk and asset risk, and so your assets are up 7%, and your peers are up 7%, but your liability is up 40%. Say, hey, good job, guys. Like, no, you just lost a huge part of your surplus. All right. And then what is his ultimate recommendation? I do agree with that you should at least do that. It gets back to that $500. He says, do what? You got $500 in 3 years. I mean, obviously you have $500 every year all the way out, rising with inflation. But just to keep things simple, you have $500 at 3 years, $500 at 30 years. The 30 years is really small because the present value is really small. So what can you do? You can get rid of the interest rate risk of that part of it because it's a small part of the liability, has a lot of risk. You can eliminate a lot of risk by just focusing on that 10, 15%. All right. I'm not going to go through the whole thing again, but just to show you there. What's my recommendation? Focus on one risk. The only one that matters, the one that you promise the employees that you're going to do. You're going to pay their liabilities. Focus on ALM because it's the only reason. What do life actuaries do? All they care about is ALM risk. I've never heard a life actuary worried about peer risk. It's like, oh, wow, our portfolio is up 6.2, but the benchmark was up 6.22. What are we going to do? They don't care. They're all focused on the liability. Why? Because that's their job, is to take care of those customers. So that's what I recommend. I even gave you an example of, here's the return of the assets, here's the return of liability, everything's good. Any questions is very simple. And then this last part gets a little tricky, but how do you increase the value of the firm, increase free cash flow, or reduce the WACC? If you have a pension plan, you're increasing your WACC a bunch. Why? Because that's essentially debt, but it's debt that is extremely systematic. So you want to talk through that. That's what this part is. This is not just the impact of debt, but specifically pension plans. Remember, it's not just regular debt, it's long duration with the COLA. It's an extremely high beta debt. So what do firms do? Well, you could invest all your money in the stock market. What's that do to your free cash flow? Nothing. Well, decrease if you're going to talk about management fees, but that's nothing, right? You're getting exactly paid for the risk you took. So there's no benefit there. What does it do to your WACC? It's going to increase it because you're just sticking money into the market. You just more beta. All right. What's the value if you do ALM risk and you buy long-term bonds? The present value of long-term bond investments is zero, but what are you doing? Significantly reducing your WACC, right? And then the last one is that's what you should be doing because that's what you're hired to do. You have a fiduciary responsibility. I wish that was the career risk people worried about. It's getting sued by the employees for not managing the portfolio, but most people say, well, as long as I'm doing what everybody else is doing, I'm safe, and they are. You can do the worst thing for your employees, but as long as the whole rest of the world is doing that as well, they really can't sue you because you have the prudent expert rule. As long as you're doing what everybody else is doing, no matter how crazy that is, you're protected. All right. Questions on this here? Hopefully you've already written. Anybody already have theirs written? 90% written. All right. This is such a great topic to bring up in an interview. I mean, you're talking about the question I got in my interview, and they should have never hired me because I had no clue, but I may have told y'all this, but they asked me what's the biggest issue we should be focused on. I would be bringing up a risk management question. See, I believe my industry is focused on my industry and not focused on the risk of the client. And we harm our clients horribly because we're focused on the wrong thing. We should be focused on their risk, not our career risk. And that's how the industry should be compensated. That would be my answer. And this question gives you a lot. They may say, well, go into that. It's like, well, for example, take a pension plan. I mean, you're going to give them an answer. If you're interviewing with HR, they're going to think you're a genius because you're going to be so over their heads. If you're interviewing from finance and you got the guy from AT&T, you may be in trouble, but at least you can, fight your argument and try to make your case. My final argument down here is I'm only asking them to do what life insurance companies have been doing for over a century and doing extremely well. And they're not $50 billion insolvent today like pension plans are. All right, so any questions on the exam? We'll practice a little more next class. All right, so let's jump back into the notes. All right, so this formula is not on this exam, it's on the second exam, so don't panic. So I gave you the standard deviation in this first exam, but what if you have 3 or 4 things you're looking at and they're not perfectly correlated? So you got to figure out the standard deviation of those items. So this is another one of those really famous formulas in finance that you should know. The weight of A squared times the standard deviation squared. Is this sounding familiar? The weight of B squared times this standard deviation squared plus 2 weight of A, weight of B, standard deviation A, standard deviation B times correlation. Does that look familiar? What do I have to do if there's another asset class? Then you got to do this with every combination. I've got to do this with A and B. I got to do it with A and C. I got to do it with A and D. Then I got to do it with B and C. Then I got to do it with B and D. Then I got to do it with C and D. Every possible combination. When you do project 2, that's what you're going to be doing, but I've already built it in Excel for you. I'll show you how I build it. So let's try it. I think we got enough time here. So this is one of those things I recommend you do this with a blank Excel spreadsheet, just like I'm doing it, just to test yourself. So let's look at bonds and stocks. We have an expected return, also known as what? What's the other word for expected return? It's the mean. Is that the same? Is the mean the same as the expected return? The mean is what? A historical number. Expected return is a future number. So if you say the mean and expected return are the same thing, you're saying if this thing's made 8% in the past, we expect to make 8% going forward. Is that a good assumption? I remember I had a debate with an auditor. So our pension plan, we assumed our assets would make 8%. Said, yeah, but you've made 20% the last 10 years. Said, yep, but my word, that was an incredible market. We don't think we're gonna make 20% going forward. And like on bonds, we think we're gonna make 5%. Oh, but you made 9%. Yeah, but interest rates fell from 10 to 5. They're not gonna fall from 5. Well, they did fall from 5 to 0. So he was right. But still, you know, if interest rates are 5%, you don't have as much gain as you had when they were 10%. But he was focused on the history. But that's essentially what we're saying, expected return and the mean. So let's say bonds are expected to make 5% and stocks make 8%. Then we have expected risk, which is another word for risk. If expected return is the mean, expected risk is what? The standard deviation, again, the historical number. Let's say bonds is 4% and stocks is 16%. I don't know if I like that number or not. So let's do some combinations. Let's say the allocation of the bonds is 100%, falling down to 0%. Oh, good job, Bill Gates. So what would be my allocation to stocks in this first scenario? If I have 100% in bonds, what is my stocks? 0, what would it be here? 10%, right? Bill Gates. Okay. So stocks go from 0 to 100%, bonds go from 100. So the question is, what is the risk of this portfolio? So let's start with the expected return. That's really easy, isn't it? If you have 100% in bonds, when you expect it to make 5%, what do you think your return is going to be? So 100% times 5% plus 0% times 8%. I hope I get 5%. All right, that looks good. What's your return going to be down here? 100% in stocks should be 8%. In between, what's it going to be? Pretty straightforward. That's just the weighted average. All right. What about risk? Can we do the same thing? What's missing on risk? We have one piece of data that's missing here. Correlation. What if the row is 1? What if it's 0? Or what if it's -1? Row is correlation. 2 letters to say row. I don't know how to, I guess row is R-H-O, right? So excuse me, I don't know how to spell row. I'm doing R-O-E. All right. So how do we do this? So in this case, we're going to do the weight of A squared times, yeah, remember the next one without looking? Weight times standard deviation times standard deviation. What's the next piece? Weight of B squared times what? Times the risk of B squared. Everybody with me? Plus what? Think college, high school algebra. 2 times weight of A times weight of B times risk of A times risk of B times what? Correlation. Take the square root of all of that. That's going to be, now in this first one, the risk probably should be 4% because we're 100% in bonds. Sure enough, it is. So let me put some block some things in here. And for stocks, it's 16%. You're 100% stocks, 16%, because that's its risk. So what happens in between? Well, in between, if your correlation is 1, then your risk is nothing more than 80% times 4% plus 20% times 16%. Right? It's the same answer. So if your correlation is 1, the risk of your portfolio is just the weighted averages of the risk, just like return. Is that going to be true if correlation is 0? It's kind of not going to be. So there it is if it's 1, but what if it's 0? It's the same there, obviously. And it's the same there, obviously, but is it going to be the same in between? It's going to be higher or lower? It has to be lower. There's no way you can get higher than the average of the two. So it's going to be lower. How much lower is it going to be? Quite substantially lower. Now, what if correlation is -1? We get an interesting point on the curve. What's the interesting point? We may not get it here because I don't know if I used the right numbers, but what would be an interesting point on this curve? On risk, do you think? Well, you see if it shows up here. So I may not have done it. What's that number right there? 0. If you have a -1 correlation, you can create a 0 risk portfolio. All right, now I'm going to ask a trick question. Don't answer truthfully. What's the expected return of a portfolio with 0 risk? Don't say 0. The expected return of a portfolio with 0 risk is, what did you learn in your first finance course? The blank risk rate, huh?
Market risk?
Not the market risk, the risk-free rate, right? If you have no risk, you should get the risk-free rate. All right. I didn't pick good numbers here, so I got the number there. I don't know how to get this to 0. I should have checked that in advance. We can try 5% here and see if that helps, but yeah. This probably is. So what I'm going to do is I'm going to do if error, comma 0. And that fixes it, right? The if error function fixes everything. So what does this look like as a graph? So let's do the row of 0, risk and return. So there's my risk, there's my return. Sorry. There's my return. What do you think this is going to look like? It's going to look like something you've seen before. There's a guy who passed away last summer. Nobel Prize winner in economics. 1950s. He invented something. Not CAPM. Sharp's still alive. But pre-Sharp. First name is Harry. Markowitz. What did he invent? This does this look familiar at all? What does that look like?
Oh, yeah.
It's not Nike. But what is it? The initials are EF. Not EF. Efficient frontier, exactly. All right, so let's figure this. We got But now, if I did the one correlation, where would that line be? Here's the efficient frontier. We know the one starts on the same number and ends on the same number. Where would the correlation of one be on this graph? So if the correlation is one, the line would be right here. And what do you notice if the correlation is not one on every point? When correlation is not one, there's a return that's higher for the same level of risk. That's what you're seeing in your bank paper. They talk about diversification. What does diversification do? It reduces risk without harming your return. So here we have the same risk, but we're increasing our return. All right. There's that good old efficient frontier. You'll see how you should be able to just build this in Excel completely off the top of your head. It's a really good way to remember how to do this. Now, if we do the negative one, that's when you get something really, really bizarre. All right, so where's the one correlation going to be? Just a straight line. Would you ever buy this portfolio? No, because you can buy this one with the same risk but higher return. If this portfolio is paying 560 and the risk-free rate is 4%, what would you do? Buy a lot of that portfolio. Right? Zero risk and you're getting paid higher than the risk-free rate. What should the risk-free rate return be? It better be 5.6% because that's a risk-free investment. Okay. Pretty cool stuff, isn't it? I mean, it's pretty easy to build. And I love Excel because what Excel does, the architecture, it's spatial. You've got to understand it because you got to put the formulas in there. All right. So we'll see who's the first in the class. So someone videotape yourself doing this with a blank spreadsheet. So we're trying to get students in the investment side to create tutorial videos. This would be a great one to do because it's not that long. You can show it to them. You could even add another asset class if you want to get really crazy with it. I'll show you how to do that. All right, we'll stop there. Before we do the math problem again, today was a very historic day. So the Nikkei hit a new record, which is phenomenal. When did it last hit its record? Yeah, December 29, 1989. It hit 30. No, that's not it. It hit 30. I got the wrong number there. Oh, my word. That's not it. Just a second. Let me go find it. 6162. That's it. But I got, boy, oh, it's the wrong column. Just a second. Column E. That's the date. So on that date, it hit 38,900. Amazingly, which is still hard to fathom, the Japanese stock market for a brief period of time was larger than the US stock market. Can you believe that? Not anymore, but for just, I don't know, like 7 seconds or something, it was larger, which is phenomenal. The Japanese stock market was over 50% of the world stock market without the US. That's how large Japan, when I graduated from college, it's like you US citizens, you're done for. Japan's taking over the world. You guys are lazy and dumb and just Japan's got everything. How far did it fall? It was at 7,000 on March 10th, 20 years later, down 82%, talking about risk. Since then, at the day it hit 39,098. And its intraday is also the highest intraday we've ever had. That's from its low, it's a 10.65% annual return. So, but they're now like the fourth largest stock market, even though they hit a new record because the US is much, much, much larger. Yeah, I remember thinking, when will Japan ever hit? I was thinking that in the 90s, I was thinking that in the 2000s and 2010s, and here we are, much, much, much later. Pretty amazing. 1989, y'all weren't even alive then, right? So you have no knowledge of that, but I was definitely alive. We were talking a lot about that. Japan was definitely there was books written around what is about Japan. They're so much smarter than everybody else. They do things so well. You had what's his name wrote a whole book on the Japanese management style and all that. That's part of that hype market. You get the same kind of thing with the NASDAQ in 2000 or 1980 or 1999. When people are making these really stretched arguments for why it's different this time and Japan's not overpriced, these 150 PE ratios. No, for Japan, that's right. For the US, that would be high. If you were making those kind of arguments, you start getting a little bit worried. Where do they go from here? Who knows? Japan's a dying country. People are aging. There's no one having babies. There's not a lot of growth there, but they're an incredibly innovative country, still doing a lot of leading edge stuff. A lot of great companies, obviously Toyota, a lot of AI, a lot of robotics. It's an interesting country. It has serious problems that are about 10 years ahead of the US. So this one thing gives me courage. As horrible as their pension plans are, much worse than ours. As horrible as their government debt is, much worse than ours. It's still a really pleasant place to live, very nice society, very ordered. So you could have these horrible problems and still be a nice place to live, but can you extend that out 50, 100 years? It's going to get tricky, but it's exciting that they're doing that well. We'll see. I'll probably have jinxed them and I'll be down 84% tomorrow, but still. All right. So we're going to keep working this problem. So what I want you to do tonight is take out your calculators and calculate all the numbers. And then I want you to do one other thing without looking up notes. Remember spacing and quizzing. I want you to answer these two parts of the rubric for the essay question using the $500 at 3 and 30 years. Off the top of your head without looking at formulas. All right. I know it's in the table in the article. You can cheat again. You can't cheat on Tuesday, but you can cheat again. Everybody understand the assignment? Finish the numbers from Tuesday. If you need the Tuesday, I have extra to finish that and then answer those two pieces of the rubric. Questions? Everybody should be working. Oh, I thought I gave it to you. That's it.
It's only like this.
Oh, did I give you just one side?
Yeah.
Oh, sorry. Oh, I must have given you the original. Sorry.
Yeah.
Oh, that means Andre, you may have got, or Elizabeth, is it two-sided? Yeah, you got the front page, you got the second page. Oh, sorry. Oh, great. There's a Band-Aid up here with scar blood on it. That's always nice to leave that in the classroom. Everybody's working, right? You got it? What you're supposed to be doing? If you weren't here Tuesday, you have to work really fast because you got to put all the formulas down. But I do have the formulas written up here. So if you want to get your calculator out and just look at the formulas. Oh. All right, give you 5 minutes. Get as far as you can. One minute. All right, so let's see how far you can get. So, real important. We professors, we're lazy, so I write my exams look the same format every time because it's a lot easier to write an exam. So you learn my format. That's not going to help you much if you can't convert that to somebody else's format. So every time you answer a question like this, always think, what are you doing? What am I calculating? What does this mean? Some students get, it's like, man, he's so picky about wording, but I am, that's why I say it's not they need to reduce their liabilities, they need to reduce the duration of liabilities. There's a huge difference in those two. So here we're calculating the duration of company's net worth. We're calculating the duration of this number. How sensitive is that $300 million to changes in interest rates, all right? What was the duration of assets? Is that 4.5? And so here, when you plug the numbers in, you got 4.5 minus 1,700 over 2,000 times 3.2 times 2,000. Hate it when I hit the numlock key. Really bad at that. Divided by 300. I thought I'd put it back on. Did any two of y'all get the same answer on that? What did y'all get? 11 point what? 11.87? Yeah, I don't know how many decimal places go out. We'll see. We'll keep it with that. I can't remember what I did. Rounding's not a big issue here. Everybody agree with that number? What else did y'all get? 6.6. So it's probably a parentheses problem. So just double check parentheses. I can try it here. So yeah, I don't know how you would get that, but yeah, so make sure you've got the parentheses in here. You have to do all of this before you multiply by leverage. All right, so just make sure you got the parentheses in the right place. So that's why you practice these problems over and over again. Make sure you got parentheses. Parentheses are really easy in Excel, but they're not easy on a calculator. So
What decimal value should you use?
I don't care about rounding, go at least one. You could say 11.9 if you wanted to, that would be fine, but yeah, it doesn't really matter here. All right, did y'all reconcile it?
2,000 divided by 300 is the leverage.
This is the leverage, right? Leverage, there's different measures of leverage, but when you did ROE decomposition, you might remember that you use total assets over net worth. That's a fairly common definition of leverage. It works really well for banks because they're extremely highly levered. This bank's not that highly levered. Most of them are 10 to 1, but this one's not quite that high. All right. So here I didn't give you the full answer, so let's talk through this. So this gives you the change in net worth in percentage terms. You got to now convert that in, and it doesn't ask you the change in expected in net worth. What does it ask you for? It asks you for the actual net worth. So what's that going to be minus? Duration is 11.87 times 0.015. Anybody got that answer? Up or down?
Negative.
Negative. 17 what? So 8.1. So that's the percentage change, but we're asking for the dollar. Well, not even a dollar change. We're asking for the ending amount. So net worth times minus 0.1781. That is 300 times minus 0.1781. What is that? Anybody calculate that? 246. That's too much. Oh, you're giving me, well, you giving me the actual.
Oh,
Now, if you want, you can do that. You can do 1 minus that if you want to. And that will give you what, 246?
246.5997.
So 247, you can round that one out. So yeah, you can take the percentage change and multiply net worth times 1 plus that, and you'll get the number. You can do that. That's perfectly fine. All right, so the 247 is what I'm looking for, not the -18. You don't get substantial credit if you get the 281, but just making sure you're reading the question.
What was that formula? That second one?
Well, this right here is the percentage change in net worth. Net worth is 300. So 300 times 1 plus that change gives you the actual net worth. The 247 is what net worth would be. It started off at 300, but because interest rates rose 150 basis points, you would expect it to fall to 247. All right. So they're out of compliance, right? Because the board says it could be 4 years or -4 years, and they're at 11 years, so they're way over. So what can they do? So this is where we try to set up the magic of the swap. They can reduce the duration of assets by doing shorter term loans, right? The asset side is the loan side. That'd be pretty ridiculous for a finance department to say, hey, can y'all sell shorter term loans? That's just not gonna work. Well, that's something that the market dictates. And you can adjust that by what rates you offer. But most firms don't offer rates based on what CFO needs to do with duration. It's just like CFO, do your job and leave us alone, because that's not gonna work. You can increase duration liabilities, right? If duration is a positive number and it's really big, you're gonna have to reduce duration of assets or increase duration liabilities, don't you?
Where did the 4 years allowance come from?
Yeah, that's what we did here. They said if interest rates rise 100, you can lose 4%.
Okay.
If they fall, you can lose 4%. So this implies your duration can't be more than plus 4 years. This implies your duration can't be less than -4 years. If this were 5%, then it'd be 5 and -5. If it were 6, it'd be 5. So you just look at the 100, whatever there, that's because of this formula. This formula is really straightforward, right? It's just a straight line. So duration times and change in yield, 100 basis points, 4% means 4 years -4 years. All right. So decrease, how do you do that? By selling longer term deposits and CDs. Again, you don't want the CFO driving the business like that. That's kind of crazy. So what can you do? You can enter an interest rate swap, swapping from what to what. We want to increase the duration liabilities. So you want to start where and end where.
And go into
Start floating to fixed, right? Go swapping from floating to fixed. How many phone calls does that take? One phone call, couple minutes.
But the setup takes forever.
Yeah, the contract is months, but once you get it set up, it's pretty straightforward. And the banks you're looking at, they're the broker dealer for these swaps, and they have swaps for their own accounts. So they're on both sides of these transactions. I don't know what investment bank JP Morgan uses when it does a swap. I don't know if it can use its own entity or not, exactly how that works. All right. So independent of question, if the board has the following constraints, are they in compliance? You could put the numbers all the way down here if you wanted here, 11 minus 11.87 plus 11.87, you could do that, but you can just tell 4 years -4 years is what you're after. You're at positive 1187. You're obviously out of compliance. Any questions on letter C? So what should Silicon Valley Bank have done? They bought assets with far too much duration. They need to go floating to fix as well.
Fix the float.
The duration of assets was too long, right?
Yeah. So they need a shorter duration.
Well, you're thinking on the asset side, remember on the liability side, right? So on the liability side, they need to start off with floating rate debt and switch the fixed. All right, we already answered that one. We already did that one. So which side? We've already answered that one. They want to be triple B side. You go from floating to fixed and thus increase duration, liabilities, and reduce. Don't say reduce net worth. Net worth. Y'all see why I'm so picky now? Y'all thought I was just a mean person, which I probably am, but still, it's good to be precise. All right. What do we get here? It's the am I doing this right?
Yep.
Divided by 4. What did y'all get there? How much? 890? 890 even divided by the 4?
Yep.
Wow. Okay. I guess that's a really long duration of. Everybody else get that?
Yeah.
All right. This is a question most people get right, so I don't know why I'm confused, but it's not usually that high of a number, but okay. 890 is not a big deal. You can do a lot of, I mean, there's trillions and trillions and trillions of dollars in swaps notional out there. But this is the notional.
Yeah.
That there's no money changes hands when you enter a swap. The market value is 0 when you enter it, no money changes hands. The money changes hands as you swap the interest rate payments. But on day one, you're not sending anybody $890 million. The 890 just tells you what your sensitivity is going to be as interest rates change. All right, we already answered that one. All right, so y'all feel comfortable on this one? And look real closely exactly what you're answering so you get comfortable with what you're actually calculating. Now, could you do this with futures? You could. I wouldn't because it's just, the math doesn't work as well, but you should be able to do the same thing. I think most of you in your banks, you're going to notice they do a whole lot more swaps than they do futures, but they can do futures. But so this should help you. That's one of the things you're going to write about on mitigation because derivatives is one of the mitigation tools banks use for interest rate risk. So you can get some comfort. This is exactly what they're talking about doing. And they'll probably have a table that shows how much they have in swaps and futures. This is exactly the math that they're doing. And it's not a massive department. You don't need 100 people to do this. You can do this with the department of 1, really. It doesn't take much. All right, so here we've got this swap where they had a expected return of 6%, standard deviation of 10%. So we're taking the mean minus the 2.3 standard deviations, which equates to that 0.75 risk tolerance, times the standard deviation. And what did y'all get there? How much? 35.7. So they what? Versus a budget or a limit of, what was their limit? Oh, is that percents or dollars? That's percent versus a limit of 20%. So they fail pretty badly. So that is percent, that's not dollars.
Yeah.
All right, so what y'all get?
Yeah.
18.3. So they I'm glad you said I love it when I work a problem and I have a typo and then someone tells me and when everybody's walking out the room, that's always really good. And they're like the last person to leave the room. So I was just waiting to let you know there's a math error in your last problem. I think there's a couple of math errors in my YouTube videos that I'll say 67 and type 76 and then use 76. So it's hard not, it's hard to do math when you're talking while you're doing the math. So you should, send a thank you note to your high school math teachers. It's not easy to do. All right. Managed futures. What in the world is a managed futures portfolio? Any clues? Managed futures did really well in 2008. If I heard that before, what kind of strategy is it? What asset class is it? The hedge fund strategy. We're going to talk about hedge funds here a little bit later, hedge fund managed futures. I was kind of managed futures in 2008. Not as sophisticated as the hedge funds, but so these are trend followers. They're watching the trend and they jump on because they think the trend's going to keep going. And then when it reverses, they jump off and they jump on the next trend coming down. So I was doing that in 2008. I was watching the market. Well, essentially what I was doing is it's falling. So it'd come down and bounce up. And then the next high was lower than the previous high. Then it dropped down and the next low was lower. So I started doing that. You can kind of follow that, right? You buy the dip, sell the next one. And then when you see it cross, you wait for it to cross lower, you just keep doing that. I did that for a few months and then I got too stressed out and I just went to cash. Fortunately, I was really lucky, but that's what a managed futures, that's what they do. They're watching these trends and they're just jumping on the trends and they're riding them. And in 2008, it was not that hard to do because the trend was like straight down. So they just kept riding it all the way down but making money on the way. So managed futures is a pretty risky strategy. The wonderful thing about it is very uncorrelated with most everything else. In fact, versus what was their budget? Limit. I'm going to say limit because your banks are going to say limit. So they fell. All right. Now we have a pension plan. They have a budget of 1.4 billion. Their number of variations is 2.17. That equates to 0.5%. So their 6% return minus 217 times a 10%, and then it's 10 billion. So I even gave you the math there. So what did y'all get there? That sounds really high. Was it that far off?
1.57, yeah.
1.57. Oh, I thought you said 4. 1.57 billion. So they fell. Everybody agree with that? I'm not double. I should have brought the answers so I could double check. But... All right. And this last question, they'll tell me what I'll ask you, but it'll be something bizarre. But if the portfolio loses 14%, the law is going to require them to fund this thing. And that is the problem with the pension plans. They have these kind of cliff funding requirements that can shock you. It's like, oh, you got to put $50 million in. You've seen that with some of the states. I don't know if you've noticed the post office. They've had that with their plans where they've had the fund and it's kind of frustrating for them. In fact, I think the post office says they make money if they didn't have these pension plans they have to worry with. So that's the biggest hurdle they have to actually being profitable. All right, so whatever the target is, you put that on the left side as if it's the VAR that you're calculating. So here we're not calculating the VAR. We're saying if we get this target, we're trying to figure out how many standard deviations that is, and then we're going to look at the total. So you've got everything but the number of standard deviations. So if I say anything about what if they make 50% or what if they lose 30%, that's going to be on the left side. You can fill in everything except for the number of standard deviations. Okay, that's the way the problem's set up. You should have done some of this in your stats class. So here you get the number of standard deviations is probably what, 2 or something? Because 14% negative minus 6, you move the 6 over, that gives you negative 20. Negative 20 equals negative standard deviations times 0.1. Divide both sides by negative 0.1, you get 2. So what's the probability of 2? So 2 is at point, I'll see that 0.9772. So you got a 97.72% chance to do what? Lose no more than 14%. What are they asking? What is the probability it will lose 14% or more? So what is that? So 1 minus 0.9772 or 2.28%. What's their probability of losing 14%? Pretty close to 0. It's possible. It's pretty close. So always put that or more in there. The probability of losing 14% or more, because we're talking about the tail to the left, everything to the left. Questions on that? We're taking a lot of time on this. You better, like, your average better be at least 10 points higher than the last class. I may have to call the entire class if you're not. Y'all can let me know if this helps to spend this much time. I'm hoping you're also learning material, not just prepping for the exam, because this is really, really critical stuff. You saw a couple of banks go under recently because they didn't do this. Any questions on any of these? Should be a simple math, and so your challenge is this question here. So you have to set this part up if you're going to. Let's simplify it and assume only 2 years. You could use 5 and 30, but 3 and 30. So you don't have to use exact amount of numbers. So why am I doing like this? If you look at Arnott's article, he gives all 70 years of cash flows. And then he does all the math. And it's just, to me, it's way too much. Just your mind, you can't capture all of that. So this is a really bizarre pension plan, but we're just trying to make the case. So the present value of the 3-year cash flow and the 30-year, what's the present value of the 3-year cash flow? Someone yell out that formula and do it really fast so I have confidence.
Well, plus or divided by parentheses 1 plus whatever the discount rate is.
Yeah, well, we'll start with 5%.
Plus 0.
Power of 3. So 4 and 31. And then the same thing for the 30-year, except for the power of 30. So there's your liability right there. $548 liability. The 432 is 79% of that. And the 116 is 21% of it. So the bulk of your liabilities at 3 years. Why? They're both $500 because the 30-year has a very, very long duration. So its present value is going to be really, really small. But what happens if the rate rises to 6%? Then you use 6. The interest rates rise to 6. What if interest rates fall to 4? So if rates rise, the liability does what? It goes down 7%. If rates fall, what does the liability do? It goes up 9%. So what do we call that? Yeah, positive convexity, asymmetrical. That's what he's talking about. You're hurt a whole lot more when rates fall than you're helped when rates rise. So positive convexity, that's the asymmetry. You don't have to do this. You can actually quote him from the article. I think he uses 150 basis points and it's 30 and 50 or something. You can quote him if you like. But that's what he means by asymmetry. Some students are like, what does he mean when he's talking about the asymmetry? And it has to do with that positive convexity. We love positive convexity when we're buying bonds. We don't like it when it's in the liability.
So to
The pension liabilities have positive convexity, yeah. There is a problem of the optionality that people can take out the lump sum, and the optionality is influenced by interest rates. The reason I'd lump sum USAA in 2021 is because interest rates are so low, the liability is massive. And my lump sum was the present value of the liabilities. So yeah, I was like, I think my good friend at Victory Capital, both of us, I called him and said, man, Brian, I was thinking about lump summing pension because rates are so low. He said, yeah, I just did it last week. So, okay, well, you're less smart than I am, so I'm going to do it too. Because it's like, what opportunity is going to be like this again with rates this ridiculously low? So there is some anti-selection on this, which makes it even, even worse, really. All right. And the other thing is, if the liability went up 9%, where did that come from? Well, the short-term liability, it rose 3%, but the long-term liability rose 33%. So how do you put this in words? Once you do all the math, the long-term liability is a small portion of the pension liability given its long duration. But it is what? Yeah, it's the bulk, the volatility of the pension liabilities. Liability exposure to rate change. That's not how you spell exposure, but is that bad news or good news? Arnott would say what?
good news,
It's really good news because it makes it easy to fix. You don't have to take 80% of your portfolio. He's saying if you just take 21% of your portfolio and hedge it with swaps, you can eliminate a massive amount of that volatility, of that pension planning liability. All right. So this is one way you can answer that. If you look at the article I posted with my rewrites, that's what I did in that table. And I love that table. It's really it's easy math because you just, divide by 1 plus the rate to the third and to the 30th. So you got the math you can do, change 100 basis points, 50 basis points, whatever you do. You're going to see more positive convexity the further out you more you change, go 200 basis points. But that's what I'm looking for on the longer term liability size and impact. That is a small part of the present value, but it's a big part of the volatility. That's what we're after. And that gets you right to Arnott's recommendation. At least hedge that part of the liability. You're not going to hedge about buying 5-year duration bonds. You got to go way out in duration to get that, but you don't have to do 80% of portfolio. You can just do, I think he said like 15% of the portfolio. All right. Any other questions on this? Because I'm going to put this out on Canvas for you to answer for Tuesday night, and it's due by 7:30. Hopefully you already have the answer. I've already seen a couple of drafts that's in pretty good shape. So you'll put it out there Tuesday by 7:30, and that's the rubric you're going to follow. If you're not sure about the rubric, give me a call Saturday or Sunday, and we can talk through it. I'll be on my bike probably 4 hours on both those days. It's a good time to talk. Although everybody always calls me right before the hill. So like, I think, so I sound like I'm out of breath because I am, but I'll still talk to you. So if there's any piece of this you're not sure about,
Those recommendations, a small part, what's your recommendation?
well, mine is to hedge the entire thing, not just that part of the liability. One issue people do have with this part here, if you increase the normal Millard Modigliani is if you increase that, it actually reduces your WACC. You remember why that is?
Can you ask the question?
So if you increase the debt of a firm, its weighted average cost of capital comes down. That's the normal theory. Why is that?
Interest benefit is.
Yeah, it's a tax shield. Why am I saying it increases it? Because we're not talking about debt. We're talking about what?
Pension liability.
Pension liability. The very fact that you offer a pension plan with long duration, positive convexity, cost of living adjustment, that is debt on steroids. That's going to make you much more sensitive. Right. So make sure that that part is a little challenging for some to get in. There's the challenge of this question. There's just so much finance in this question. Just asking the question, there's so much finance. I could say, should you borrow money to buy stocks in a firm? But I'm not asking that. I'm asking, can you borrow money that has ridiculously long duration, positive convexity, and a COLA, and increase the value of the firm if you stick that in the stock market? So I'm real precise. It does work if a firm just borrows money normally 5 years and put it in the stock market. You'll get the same answer, but it won't be quite as strong as it is with the pension plan. So just the fact that you have a pension plan is making your firm much more exposed to economic risk. All right, so walk through that. If you email me your answer, you're not gonna get much of a response except for a very high level. I'll just say, wow, that part of the question is really, really bad. You're not gonna get much point there, but I'm not gonna get you to like a strong answer. If you want to call and specifically walk through things, I prefer when students say, hey, highlight this one part. What does that look like? I can handle that better. This weekend, I've got to grade a massive paper for one class, so I'm going to be somewhat distracted, but that's why I say about bikes. Guess how many papers I'm grading while I'm on my bike? None. I haven't figured out how to do that yet. So that's why it's the best time to call me is when I'm on my bike because I'm not distracted. All right. Any questions on the exam? Because this is your last chance other than calling me.
So in our essay, when we're talking about the article, like you want to include like basically all of that, you know?
Yeah, the whole thing. Yeah. It's a long essay. It's almost a paper, but due as part of an exam. Yeah. It's one of my favorite questions. You don't need you can talk about him. You don't have to like have a bibliography or anything. Yeah, I mean, I know it's coming from Arnott. Now I will say I could probably find this guy. One of the consultants we talked to, his argument was 70% in stocks. I may have told y'all this before, but what was his name? Oh man, I'll have to find him. We stopped talking to him after he said this. I said, we're not going to talk to him anymore. But he said, hey, 70% in stocks is fine because stocks have long duration. And he looked at the formula for stocks, the dividend discount model, and you have interest rates right in there, right? The risk-free rate plus beta times the market risk premium. But these stocks have long duration. Were stocks up 30% in 2008 when interest rates fell? They weren't, they were down. Stocks don't have positive duration. Why? Because there's a lot more in that formula. There's also growth, there's risk. The risk-free rate falls during a recession, which is when all the other stuff in that formula blows up. So I'm so glad I didn't do that in 2008 because it wouldn't have worked as well for us. All right. Now, last class I did this, and we've got like 15 minutes to go. So I want to walk through because I could tell from some of y'all's expressions, not that I'm great at reading expressions, that y'all are like, what in the heck is he doing? I'm not following. Is that true? What is he doing? So you're going to do this in your second project. I've already built it all for you, but I want you to be real comfortable with what we're doing here. We could add a third asset class. It gets a little more complicated then, but there's 3 components to this model. What were the 3 components? What do I need for each asset class? I need an expected return, an expected standard deviation of risk, and an expected. What was the third piece?
Your allocation.
Building fish frontier, I need return risk and
Oh, the risk free.
not the risk-free rate. And correlation, all right? So you need risk, return, and correlation. They're all expected values. So I always say, I even say expected correlation, which most people don't say that. I'll show you, we're gonna have a big debate on that. That's a great essay for the second. Does diversification actually work? All right, so I have return. What did I get return? We'll talk about that when we do project 2, but for bonds, I keep it pretty simple. If the current yield in bonds is 5%, I use 5%. It's essentially, especially for treasuries. If you treasuries are yielding 5%, that's your best forecast for what treasuries are going to make going forward. Stocks, some of y'all took my investment class. What's the return for stocks? Dividend yield plus expected growth in earnings. That's pretty straight. I don't know why I keep getting. I am now a host. How did I not become host? All right, I don't know what's going on. So I have those assumptions. How do I get rho? I use history for that as well, but that's also a little problem. We're going to talk quite a bit about correlation because that's the big problem in this. The correlations are very unstable. But once I have all of that, this is what you're going to figure out on your project is what allocation should you have to give you the highest return at each level of risk. Here I only have 2 asset classes, so I'm just running 10 scenarios. But what if I put all my money in bonds? Or what if I put all my money in stocks? All right, my expected return is so simple. I just take the return on bonds times this weight plus the return on stocks times this weight. That's real simple. What if I had 3 asset classes? The same thing. Each weight times its return. That's real simple. There's not much difficult math there. But then on correlation, what do I have to do? Let's see who remembers correlation. Or the risk of 2 assets. Any takers on that? Not looking at notes? Because y'all should, this is a formula. There's like 20 formulas you should know off the top of your head. This is one of those. Anybody remember it before you graduate? So this is your chance. If you don't know it yet, this is the semester to learn it. So this is a formula you should know. Anybody remember? No takers?
Weight of A.
Right. All right, plus what? Then it gets real easy.
Weight of B squared.
I can't hit escape. Weight of B squared times the variation of B squared. That's not a hard formula, is it? We haven't finished it yet, but that's pretty straightforward. Then what do? Well, just repeat it one more time. Except for what? 2 times weight of A, not squared, times weight standard deviation of A, not squared, times what? Weight of B, not squared, standard deviation of B, not squared. So that's not difficult. It's just weight, standard deviation, weight, standard deviation. Weight of A squared times standard deviation of A squared. Plus weight of B squared times standard deviation of B squared. Again, 2 times weight A, SB, SA. Right? It's not that difficult of a formula. What's the last thing we do? Not yet. One more thing. You need 3 assumptions. Return, risk, and correlation. And then you take the square root. All right, so that's the formula. If we have 3 asset classes, you just gotta do every single possible combination there. 3 asset classes, you do this part, 3, you do weight A, you do B, you do C, and then you have to do every combination, A and B, A and C, B and C, right? But it's just, what if you have 20 asset classes? I'll show you how you set that up in Excel. It looks like a little pyramid.
And in that case, you change the whole formula to reason.
No, you just keep doing the 2 over and over again. You got to do 2 times all of that for A and B, 2 times all of that for A and C, 2 times all of that for B and C. Yeah, you just keep doing that over and over again. We usually do as a pyramid, so we get each thing and you just add them all together. So yeah, I'll show you in the Excel file how to do that. So that's all I've done here. Is I took the weight of A squared times the standard deviation of A squared plus the weight of B squared, which is stocks, times the standard deviation of B squared, plus 2 weight of A, standard deviation of A, weight of B, standard deviation of B, times here the correlation was 1, and I took the square root of that. Here I did it with 0, here I did it with 1. So let's go back to this one and do the graph. You have to do an XY graph. So there's a good old efficient frontier. Kind of looking like an efficient frontier, isn't it? A little bit. So where's your line if the correlation is 1, 0, 0? You just connect the dots. It's way down here, right? What happens as we approach 1 on correlation? What's this line going to do? It's going to start flattening in. So if I take my correlation to 0.5, what is it going to do? Watch it. It's going to be magic here. See how it gets much flatter? Boy, I'd mess up somewhere. What in the world is that? Huh. I don't know what happened there. Is that where did I put 0 in here somewhere? I don't know what. Boy, okay, we just violated the rules of mathematics. That's the portfolio you should buy, but I don't know where it's come from. 9% risk. Yeah, I don't know why I did that, but really bizarre. Oh, I hit the wrong number. Sorry. Sorry. Excuse me. Ignore the man behind the screen. All right. I was supposed to change this. So if we change this to if I change this to 0.9, what's this thing going to do? It's going to flatten out. And you can already correlation between US stocks and non-US stocks. It's pretty close to 0.9. That diversification is not there. What happens if the correlation goes negative, negative 0.5? It gets pretty skewed. So we love negative correlations. That reduces your risk a lot. In fact, a negative correlation, you almost like standard deviation. A bunch because it has high correlation. That's why gold is not frequently put into portfolios, because it has negative correlation and it's very volatile. All right, but the 0 line is what gives you that efficient frontier looking shape. Now in your project, correlation is going to be so high, your efficient frontier is going to look like a straight line. It's not going to be straight. It's going to be a little bit bowed, but it's going to be hard to tell because correlations are so high now. But I encourage you, sit down with a blank Excel spreadsheet and see if you can build this from scratch with no notes or anything. It means you have to know this formula, but you're a finance major, an actuarial major. You already know it. This is second nature to you. So this is a formula we use a lot. Why is this formula so important? Because I have a typo in there. What's my typo? It's not divided, it's times. Sorry, I hit the wrong button. Why is this formula so important? Because the number one tool for risk management and finance is diversification. It's that number right there. It's our number one tool. We use it more than anything else. You're seeing it, all of your banks' annual reports, where you look at the VAR and they have that diversification effect. You're seeing it in every wealth manager. Don't put all your eggs in one basket. It's the number one tool. How well does it work? We're going to talk about that. It's pretty sorry risk management tool. That should scare you. That in finance, the number one tool we use doesn't work very well. So we're going to get into a big debate about that. Does that mean put all the eggs in one basket and then really watch that basket? That's kind of what Keynes said, but we'll talk about that. We're going to see a couple ways to debate that, but that's an essay for the second.